Hello, Greg Kuda.
Hey, Mike, how are you?
I'm doing good. How are you?
I'm doing well.
All right. I should make sure. Oh, oops. I got to get rid of my extra feed there. um, can you hear me all right?
Yeah, I can hear you. Can you hear me?
Uh, yep, I can hear you. I just want to check. I'm going to go on mute right now and make sure I'm going through the right microphone. Uh, now you can hear me?
Yeah, all
Okay,
good.
perfect. So it's weird when I put my computer to sleep at night. Sometimes when I wake it up, it changes devices.
Yeah, no, I get that. And floating between all the different video conferencing platforms, inevitably, I'm always resetting. Mostly audio, sometimes the video, but audio, I'm like resetting it constantly.
Yeah, for sure. Um, all right. Well, why I think we're getting ramped up. People are rolling in. Um, we have what's today? The 13th. 12 days till Christmas.
Yeah,
11 official shopping days.
it's coming.
I know my son's beginning to panic because he keeps sending me texts. Do you think mom would like this? uh, but
Uh,
he's been everything he's been.
I'm impressed. We haven't gotten to that point in our house yet, so.
Well, he's working now, so he has a probably some money burning a hole in his pocket, evidently.
Yeah. I've got two of those in my house. That my son is more of a saver. My daughter likes to spend like she's on shore leave. So
It's kind of weird. My kids are about the same. My daughter has no sense of value.
yeah, yeah, yeah.
Um,
It literally is burning a hole in her pocket. So
and my son, he just doesn't care about stuff for the most part. It's kind of,
yeah, that's
I'm
pretty funny.
sure, I'm sure that'll change. But get this, so my son is working now at Chick-fil-A and
Nice.
$16 an hour.
That's good stuff.
That's more than I was making when I was, in college as a union construction labor.
Yeah. No, that ranks up there with one of my first jobs out of college, where I was told. Hey, what do you want to make? And they came back and, well, this is what we pay. If you want the job, then
Yeah,
it's
right.
the experience, right?
Exactly. All right. Well, let's kick this thing off. Welcome to Lumber Futures from the Free Seats. Greg, you still need to
Sure,
share your
my.
screen,
Yeah.
um, where we talk all things lumber futures and what is affecting the markets. Um,
Yeah,
big day
lots
today.
of lots of good stuff today. Um, there we go. We'll jump right into it. Yeah, the big news obviously today is CPI. And we can go right into that. We'll come back to some of this other stuff, but let's just go right into. You thought I would have had this up
So,
front, but
the reason CPI
here we
is
go.
a big deal today is it is one of the key components that the Federal Reserve looks at in assessing the overall level of inflation. And it's a known fact that this is what they're watching. So the entire world economy was watching what was happening with this number today.
Yeah, and initially when it came out, it was lower. I mean, again, the market, the Dow at one point was up 850 points. I think we're negative right now.
Yeah,
But
we're
the
down.
insanity of okay, they were expecting 7.3%. It came in 2/10 lower at 7.1%, and the market euphoria to be up 850 in the Dow is just insane. And I'll somehow, okay, and I'll go back to, you can kind of see the headline, kind of expectations versus reality. The one sticking point here is shelter rent, and when you look at housing rent, you're up 7% plus year over year, which is still a big number, but like this puts it into perspective. 7.1%, and when you look at all items, obviously you're well off the highs back in May and June. But historically speaking, you're still nowhere near the Fed's target rate of 2.5%. And that's why, as much as the market wants to get excited, I think the Fed, watching these metrics, these numbers come out today, I have to think that Jay Powell was seething just to watch equities, the initial rally where, when you look at jobs, you look at inflation, what has the Fed collectively done here so far? There are signs that inflation is moderating, but moderating and going down dramatically are seemingly, in my mind, two different things. And, with each passing month that you're, each passing month that you stay up these elevated levels, to me, you're doing significant damage to the economy, and there's no going back. And I think the Fed, is well aware that there's a lot of work ahead, and the last thing that they want to see is the equity markets rally here. I think that's just the ultimate slap in the face of what the Fed's trying to accomplish.
You talk about that rent component. How do rents go down? Rents go down. It's simple economics. When the supply of units is greater than the number of people looking for the units, right? I found a really interesting article this morning, and I'm going to share it real quick here. So young adults living with parents fuel luxury boom, Morgan Stanley says. That's the headline that caught my eye. I'm like, okay, what's this about? And I come down here, and recent U.S. Census data shows nearly half of all young adults aged 18 to 29 are living with their parents, the highest level since 1940.
Yeah, I was going to say, are we turning into Italy, or we're just going to have generations of people live with their parents here? Yeah, that's wow, that's pretty. And having kids, entering into this age demographic, that we're going to have luxury shoppers of our own here soon, Mike.
I get, well, yeah, right. I mean, I remember, when I was 18, I just couldn't wait to get out of my parents' house. Like, the idea of living on my own was fantastic. But there were probably more availability to get a house, or, find some place to live.
Well, it's funny, the next chart I had after that CPI is cost of owning versus renting. And, you can see, what we've, this, flip the switch where you have this brief respite of where it was really advantageous to own, and then now you forced people back into the renting scenario. So ultimately, rents will come down, but when you look at those CPI numbers, unfortunately, from a housing standpoint, the one big negative headwind still facing inflation is housing. Where you're not seeing, it's still, from an inflationary standpoint, year over year, you're still up massively year over year right now, with both cost of ownership and renting. Let me see here.
It's going to be a common theme.
So, again, the one positive thing, and this is from this is RealPage, but I think this was maybe John Burns, where you did have 3 consecutive months of lower rents, so that's encouraging. And then we'll kind of go back to I hate jumping around like this, but we'll kind of go back to the beginning. But you also are seeing the 4th consecutive month. This would be the 5th consecutive week now of mortgage rates falling, where again, you're back in that sub 7%, 6.5% threshold. But in order for again, my personal opinion on the stuff that I follow internally is that you need really rates to go sub 6%, really sub 5.75% to really see a catalyst for the single family component of housing.
I would agree with that.
But we'll go back to let's go back to the beginning.
What you need actually is the mortgage rates to stop going up, for them to pull back and stabilize. Because even when they start to pull back, people aren't going to jump in because they're going to think, oh, they're dropping, I'm going to hold off and wait.
Well, and so that's going to be, the critical analysis of tomorrow's FOMC. Look, the expectation is going to be a half basis point increase. That's pretty much baked into the cake. It's going to be, what does Powell say? And typically when they reach terminal Fed funds, they stay there for 11 months before you pivot off there. And the market's expectation is that no, they're going to pivot off substantially sooner. And you really need to see a change in the inflationary tone, in the labor tone, where I just don't know how they're going to overreact, especially in order to regain credibility. How you're going to get this overreaction to where you're there for a month, 2 months, and then you're immediately going to reverse course and start lowering interest rates. Where I think the reality, at least history shows, you're there for 11 months at that terminal Fed funds rate before you start to come off. And to me,
But
that's the more likely scenario of what lies ahead.
correct. But the Fed's fund rate is overnight money.
Yep.
That is not mortgage money.
Yeah,
So
absolutely. Absolutely.
what we could see, and we're already seeing the yield curves inverted, meaning that you get paid more to borrow your money overnight, or for 2 years than you do for 10 years.
Yeah.
So
Yeah.
even though that overnight rate is pinned, like you said, for 11 months, the tail wagging the dog, is that the right analogy here?
Yeah.
The mortgage rates and 10-year rates can come down. Granted, they're going to be held with a pretty tight leash coming down because of the overnight rate. But
yeah, no, I think that's a great point, Mike. I think the 30 years, the 30-year, and the long end of the curve has nothing to do with the intermediate or the short term, where you definitely could have that float and kind of see long-term rates come off in anticipation of what lies ahead after that 11-month, what lies ahead a year out from now. The big takeaway, obviously, this was taken earlier this morning, but at one point the Dow was up 850 points. Right now it's kind of unchanged, but you've had a nice rally over the last half week or so. And the one thing that jumps out here is you look at 10-year rates. Again, at the high water mark, we were 4.25, almost 4.5%. So you're back to sub 3.5% as of this morning. So you're almost back to September type levels now, as far as 10-year treasuries. And so when I flip here, here's the S&P last week. You can see a narrowing. Those red bars, or the Bollinger Bands. You can see, you're narrowing. You're going to get the breakout. And today was the attempt to break out to the upside. If you can close above, and this is the December, just for continuity, just so everybody's aware, March is the front month now, but I just wanted to have continuity in the charts because March is trading at a premium to December. But you're trying to break out to the upside, and best case scenario is you get a move up to 4,300. But again, I said this last week, I've said this time and time again, unless the underlying fundamentals support the market, you do not chase momentum in bear market structures. And pick a market. Most markets are in bear market structure. So I would be very cautious in chasing this strength in equities, where people that bought the highs today are kind of scratching their heads now. What did I just do? And so that this is something I was going to share last week, and I just didn't have time to do it with Ashley. But the reason I follow the S&P, when you look at ETFs, assets under management, spiders, here, iShare Core S&P, Vanguard S&P, you can see that the S&P is by far the largest of the traded funds. By far, this is the biggest traded. The S&P of the indices is the biggest, is the largest from a market share standpoint, and that's why I'm a huge fan of the S&P.
Of course, it is hands down the most diverse. It gives you the best view into overall economic conditions, United States and worldwide.
And I don't want to spend too much time on these, but if anybody wants these charts, you could see how the big investment banks make their money. And I thought this is pretty good, pretty interesting how they're how they have these diversified portfolios. But you can see how this, when you look at a JP Morgan and even a Goldman Sachs, this interest income component is going to start to grow dramatically. above and beyond just internal trading. It just anybody wants these, let me know. These are really neat to look at. I'm not going to spend too much time on these. But when I look at commodities in general, you've definitely seen a nice bottom. I mean, look at gold leading the charge to the upside, copper, wheat, and crude definitely showing signs of a bottoming. And the big catalyst here is the US dollar index. And as the dollar comes down, it just gives more tailwinds to commodities, dollar denominated commodities. And here's the dollar. So at the high water mark, we topped out just under 115. And you can see we're sub 104. So as this dollar pulls back, it really gives a nice floor. It gives the upside potential in physical commodities, and lumber is a physical commodity, so it becomes interesting to watch, especially if the other commodities like energies, like precious metals, if they continue to push higher. Does this ultimately lead to short covering in lumber? We'll see how separated out the commodity funds are looking at lumber versus the basket of other commodities, especially with a weakening dollar structure. Something to definitely watch here.
And I think watching the dollar and how it trades against other currencies is a really important data point. The top traders across the world are currency traders because currencies affect.
Yeah, and so that's a great point. And this is the last 5 days. Winners of interest, natural gas here. You've got commodities like silver, palladium, wheat, even Bitcoin. Here's the Nasdaq, the equities. But the one thing that stands out here, as the dollar comes off, the beneficiaries are other foreign currencies. So you've got the Aussie dollar, New Zealand dollar. The other ones haven't quite made it to this list, but the British pound is up, euro's up. You're starting to see, and when you look at the losers, then here's the U.S. dollar. Um, the one thing that's finally off this list, and if you look at it on a 1-2 day basis, lumber finally got off the red here, which is encouraging. So we'll kind of get into lumber, but and again, going back to 5-day, U.S. natural gas is up close to 30% over the last 5 days. And so, obviously there's natural gas that trades in Europe, but just energy inflation in Europe, a recession in Europe is pretty much unavoidable at this point. Look at some of these net changes on an annualized basis. Just pick a country. Best case scenario, you're paying 8% more, and then you stair step up from there. I mean, look at Italy, Netherlands, Denmark. I mean, some of these areas are pretty cold areas, so that's just insane year over year to heat your house, to consume energy. How does Europe not go into a recession? The reality is they are in a recession.
And think about how much power it takes to run a sawmill in Europe.
Yeah, absolutely. Absolutely. And, unless you're burning your own pellets or sawdust and you're completely, like I know that there are sawmills that basically have less than 1%, 5%, 10% waste, depending on, so that's your best hope, is that you're consuming your own bio waste to fuel yourself. If not, that this hurts for sure.
And well, you still have to get the material away from the sawmill onto a ship somewhere. The whole supply chain is affected by energy prices.
And then I'm just looking here, Matt, isn't March the front month? Last month,
lead month on January 1st.
Yeah, correct. That's correct. Yep. Yes, but Jan becomes the spot month, and we'll look at that in open interest. So this is from last week, just payroll. So this is something, what the Fed wants to see is this trending back down, and they're yet to see this from a payroll standpoint. And so when you look at CPI, CPI is moderating, but look at your wage growth, look at CPI. Here's your wage growth, here's CPI, where's the convergence? You're still paying more and getting paid less. So these are all headwinds facing the economy. And so we talked about rates. I'm not going to dwell too much on this. So the one thing with housing, percent of builders actively using rate buy downs to entice people to buy. And you can see a national average is 75% of home builders now are offering people rate incentives to encourage people to buy homes. So, that's something to watch to entice people to come in and buy, to get them down sub 6.5, to get them sub 6% on their mortgage. And again, anybody that's buying a house right now, your expectation, the reality is you hope that you're going to refinance in the next 2 to 5 years at some rate cheaper than what you're financed at today.
Absolutely.
And you kind of mentioned rates earlier, and you're seeing this with the knob spread, where the last two major reversals with rates,
Okay, hang
you're
on for a
already
second.
through
The knob spread stands for
yeah, I'm
note.
sorry, no, notes over. This is 10-year treasuries, and this is just a spread between the 10-year treasury and 30-year,
Bond.
technically a 30-year treasury. This says 30-year mortgage, but
Right. And knob
treasuries
stands
and
for notes,
yeah.
notes
So
over
this is
bond.
actually an exchange traded spread at the CBOT, CME. So
And
something to watch here as far as you could see that shift, Mike, what you referenced on the long end of the yield curve, where 30 years start to moderate more substantially relative to the 10-year, where just because the Fed funds goes to 5% plus, sorry, just because you go to 5% plus doesn't necessarily mean the long end of the yield curve has to stay or go higher. You could ultimately see that convergence where you start to narrow. What this is telling you is that right now the spread between the two is extremely high, where you could ultimately see the 30-year, the long end of the curve start to come back in and converge back in with the middle to short-term short-term interest rates. And then, here's market expectations. And again, we kind of are looking for the Fed to reach their Fed funds terminal rate, the zenith, into the first part of 2023. But, again, this is forecasting. And again, this is just this is just a combination of economists, and you see that. Are you realistically going to see rates start to come down? Is the Fed going to lower rates into the end of 2023? I mean, that's the expectation versus, again, once you reach the peak, history shows you're there for about 11 and a half months before the Fed starts to pivot off of the highs. So something to watch down the road. We did CPI, did that. This is kind of scary. I don't know if I'd want to be a real estate agent right now. 30% of real estate agents in the U.S. couldn't afford to pay their rent in October. Something to watch. Yeah. I'd have to think that mortgage underwriters are probably in a similar predicament right now.
Or how would a mortgage banker?
Kind of skip over this and get into lumber here because I know we're bumping up against it.
Before we jump in, I want to share something that it's so important to know the source of your news. This was in Fortune magazine or Fortune, and it was models predict, what's going to happen with the housing market in 2023. And the ones that said the market is going to be the best: Realtor.com, CoreLogic, Home.com, Mortgage Bankers Association, Zillow. These are all the top ones. And you can kind of see there's a theme there. They all rely on the housing market.
You saying they might have skin in the game?
I'm saying they might have skin in the game.
Yeah.
Now, as we move towards the bottom, now you've got Wells Fargo, Goldman Sachs, ING, Morgan Stanley, KPM, and finally, John Burns is at the bottom of the pile here. It's spin, I guess, is kind of what you want to put on.
And again, I see the two that jump out that I think are phenomenal. If anybody wants actual unbiased housing data, they're not trying to paint pictures. They're just giving you their analytics without any type of bias. Zelman, Ivy Zelman, and John Burns are first class as far as the information they provide.
And Zonda.
Yeah. Yeah, and Zonda. I'm sorry, yeah, Alley Wolf is really good too. I didn't see Zonda there.
So know your source, I guess, is what I'm saying there. All right. Oh, you know what? Actually, one other comment on the housing market, and let me just jump out of here. So yesterday, I was on the phone with large national home builder, publicly traded, and take it with a grain of salt. But what I was told is their cancellation rate is running around 40%, and in September, their sales were off 40% from last year. So not only is their backlog shrinking due to time, it's shrinking due to cancellations, and they're just not getting that many new sales. So, like, housing market is definitely
yeah, and that's not a one-off. If that's them, that's everybody in the space.
Oh, 100%. And ironically, they kind of don't care so much because many of their home builders buy land and then put a house on it to increase the value of that land. They have land options to buy the land. They want to renegotiate these and buy that land at a lower rate.
Yeah.
So
yeah.
if they're not going to build a house on it, okay, great. Let's just renegotiate that.
And again, the good news is that everybody's built out their war chest and can kind of weather the storm here. Especially if the reality is this isn't going to be a repeat of 2008, 2009. Well, you have the cash coffers now to weather the storm and just get into the 2023 might be a struggle, but ultimately there will be a light at the end of the tunnel just by virtue of we're still massively undersupplied as far as where demand is. It's just you got to have some of these metrics come down back to reality. When it comes to lumber, we made the low last week of 82.80. We continue to stair step lower. Again, we've talked about you're finally back into pre-pandemic type levels as far as valuations are concerned. This is another continuation chart, and you can see, we're kind of in this wedge coil formation, and ideally you would see some kind of a breakout, and the reality says it should be easier to break out to the upside at this point than the downside. In my mind, I'd love to say we're going to break out, Mike, but I guess the question is why. I think you could just be stuck in this 375 to 450 to 460 range. And, let me throw out this scenario. Take away the ridiculous ranges we just spun out of over the last couple of years prior to 2020. Really, the exception was, I guess, 2018. But prior to that, on an annualized basis, lumber traded in an $80 to $100 price band year after year after year. What if you were just stuck in a 375 to 460 trading range for the foreseeable future? I think, we all want to try to project that there's this extreme move coming, and I guess the devil's advocate says that well, what if we're just stuck in this $80 to $120 price range?
Yeah, there's no reason why we couldn't be.
You get into the daily chart. Again, we're trying to break out of this long-term bull flag. People always ask me, well, where were the commodity fund shorts bail? I think it's up in this area, which is your Bollinger Band high, which is your 44-day type moving average. Personally, I think when I look at futures, I think it would have to be above 450, and you'd have to be up there on a consecutive weekly basis to get them to kind of alter their course, or maybe, again, they decide to throw in the towel because of other physical commodities rallying. But if it's truly based upon the headwinds of housing, I don't see any green shoots when it comes to housing. If it's just going to be based upon a housing play, then I think it's as simple as the funds are going to roll the vast majority of this position into March, and that's going to happen starting this week into the next 2 weeks. You're going to get this massive shift, and we'll come back to some of this, but just jump into open interest here. The vast majority CFTC funds, managed money funds, 53% of the market, 95% of this is still concentrated in January. So, okay, they're going to liquidate some percent of this, whatever they're going to roll, probably, 90, whatever's going to get rolled, whatever percent you want to say that they're going to roll, 100% of that's getting rolled into March here in the next couple of weeks by the end of this month. So that's still ahead of us. You can see commercials gradually building up a long position. Again, producer shorts virtually non-existent, where even at this premium to physical cash, you're still not really enticing sawmills to come in and sell to capture that. Apparently,
Well,
they don't like making
I look at
money.
this, Greg, and I look at the number of traders in the category. You're telling me that 5 entities have a position greater than 20 contracts. I mean, I know.
Yeah, no, those are pretty scary numbers. And again, this should change, and this will change as you shift the legacy open interest into the mini, because of reporting is going to be significantly lower thresholds now to be considered a reportable trader, like substantially lower. It's going to be the equivalent of, I think, like 6 legacy cars now with the mini. So as this moves, as this open interest moves from here to here, these numbers are going to grow pretty substantially, because more and more people are, and I'm seeing this firsthand, where more and more people are getting the CFTC request to fill out the Form 40. So if you get that form, if you get a CFTC email, it's legitimate, and all they're looking to do is categorize you here, where if you have a position greater than 20 with the legacy, I think greater than 6 with the mini, you will have to fill out the CFTC Commitment of Traders report. And all they're looking to do is see who you are, what you do, so they can categorize you amongst these groups. You should feel honored that you've made it on the CFTC's radar.
That's the one time you should feel.
Yeah, honored. Yeah, that's the one and only time you want the CFTC reaching out to you. Absolutely. So from an open interest standpoint, I mean, we're still hanging in here. So, if the funds are going to exit out, there's certainly no sign of it. We continue to see, open interest rebuilt nicely from 2,300 back to the 3,000 area. We continue to lightly grow the mini. So again, my thoughts are and we'll go back to basis and here's your Jan March spread. The likelihood is, as the funds roll this position, Jan is going to continue to go to grow a premium to March into the end of the month. Conservatively, my thought is you go to 5 to 10 over for starters, and then we'll see how many of the funds truly roll versus liquidate. But you're going to get, with each passing day now, Mike, you're going to get those bids underneath the market from the commodity funds, either short covering or rolling Jan into March. If you're going to get new selling, it's likely going to materialize in the March contract now. If the funds are going to sell, they're done adding to Jan, they're going to add to the March position.
And the activity of the funds, rolling their position is going to open up basis opportunities.
Yeah, sure. Absolutely. So when you jump into just quickly show, I mean, here's what we've come out of. This is thanks to Alex for putting this together. This is a lumber futures histogram. So here's the last 2 years, and this is what we've been conditioned to, where 22% of the time we're at 350 to 500, 47% of the time we're at 500 to 950, 20% of the time we were at 950 to 1350. Okay, this is what we've just come out of. So these expectations that we have to go back to more extreme numbers, that this is still fresh in everybody's mind here. And then as you look at a 5-year, you start to drop dramatically, where 65% plus of the time you're between 350 to 650. And then when you go into the 10-year, Here's your reality that 20% of the time you're less than 300, 26% of the time you're 300 to 350, so over 50% of the time you're between 300 to $500. I mean, is there a reason to think that you deserve to be greater than 500 right now, or great? The market's got some work to do to prove that you belong back at, again, the last 2 years. Again, this is what we've been conditioned to think lumber is versus the reality of what lumber was pre-pandemic. Are you kind of going back into these old trading ranges? And again, personally, I think until proven otherwise, until there's a shock to the system or demand starts to show green shoots again, this is probably the reality. This 300 to 500, or let's say 350, 375 to 500, and that 500 plus is probably going to be because of commodity fund short covering more so than anything, supply constraint related. I know that there's talk of the BNSF. There's an embargo going through Vancouver, similar to what we had last year. And that's something to definitely watch because they referenced all commodities. And it's funny how it came out on the 9th of December. And so let me jumping all over here, but this is what the CN put out on December 9th. A full embargo on all commodities starting this past Sunday. And it's all labor-related type issues. Again, a year ago, it was equipment issues, it was weather issues. But it's funny how this date coincides with until U.S. legislators pass the act that you're not allowed to strike if you're a railroad. The initial strike date in the U.S. would have been December 9th. I just find that comical that, okay, you're going to mandate that we can't strike, we have to work, but that doesn't mean, okay, we're going to, showing up to work and actually working are two different things. So I would expect the railroads to play this up to the nth degree, and then the byproduct of this will be the sawmills feeding into this as well, that, well, we just can't ship, you need permits, west of the Rockies, that kind of stuff. But like we've seen over the last couple of years, the big difference again this year versus last year, the last 2 years, especially when you look at, here's rail car velocity and then here's Canadian, you can see how you're getting close to that time frame where you fall off a cliff as far as rail car traffic in Canada. The big difference with not just lumber, but commodities in general is overall demand. The demand is just not the same as it was the past 2 years.
And just going back to your histogram and kind of this type of news and overall inflation, I think the floor price is definitely higher today than it was 3 years ago, than it was 5 years ago, 10 years ago. So this histogram stuff is great information. Are we going, we have the potential to go crazy again, of course, but the reality is we probably have a higher low and then we fall into a range. And
again, to say that you can't go back to extreme numbers, well, we just came out of them. Of course you can, because we have the precedents to do it, but there better be some underlying fundamentals to support, again, why are you going to rally? It's going to be supply constraint driven rallies. Again, supply constraint driven rallies are usually violent in nature. They're short lived. As you float out to some extreme number, and I'm going to go back, Mike, to here's the weekly chart. Okay, so here's your Bollinger Band high in the weekly. You spike up to 546. Let's say that the funds just liquidate everything. They come out of all their shorts. It gives a $150 rally to the upside. At the end of this, do the underlying fundamentals support these numbers? And when you look at, go back to CFTC numbers, okay, commercials are not short at all. Commercials are long. We know that the funds are short. So on any bigger rally, sawmills, commercials, because of the basis opportunities, are going to be clamoring. They're going to be more than happy to exchange these shorts. You would love to see these numbers flip where managed money gets blown up. There are 150 shorts and commercial shorts grow to 1,500. But the higher you go, it's going to be that inverted triangle as far as the more commercials will come in, the higher you go. based upon underlying fundamentals. Do you belong at those higher numbers, on those histograms? Is this the last 2 years, or reverting back to the last 5 years, 10 years? And this is all the analysis of, what I, know your market. Are you in a bull market, bear market? And you could have all the hopes and dreams you want, but it better be rooted in reality of what kind of market structure are you in. And do you see the green shoots coming with housing or the economy for that matter? And trust me, I'm looking, but I have a hard time seeing any green shoots right now.
And you can't argue that lumber was in a bear market for the previous 12 months or more.
Well, I mean, again, you want to go back to here's your ultimate bear market structure right here.
Sure.
You make the high in the spring, and you collapse thereafter all the way down. And again, are we there yet? We're definitely getting closer. But what you'd like to see are more systematic shutdowns, not just originating out of BC, not from just one or two mills, the obvious ones. You want to see a collective approach from producers, North American producers, European producers. You want to see aggregate producers say, this is enough. We've reached the point where we have to do something about it. And then that begins to set the stage for not only putting in a floor, but ultimately moving up off the floor to higher numbers, more achievable numbers, and sustaining them.
And it does appear as though we are in a transition between a bear market to the next market. It could be sideways.
Yeah.
Look, supply has headwinds or has increased costs. I was told that logs are becoming hard to come by in Europe right now.
Yeah, they are. The one big thing in Europe, the beetle kill, and talking to my Euro mills, the beetle kill is gone. That wood is gone. So now, you're hoping that log costs come out, but a lot of logs in Europe are privately held, small landowners, kind of similar to down south. And if anybody, can please jump in if you disagree, but they're still living in the past of what their expectations are, where the log costs are very slow to come down versus the returns. So Europe is definitely seeing pretty significant curtailments. And when you look at staying within the European sector, Western Europe is DOA. The only real glimmer of hope for Euro mills is really the Middle East. And that's really predicated on, if you can get Brent crude oil above $80 a thousand, it really creates a lot of organic opportunity for Euro mills staying in the Middle East or going to the Middle East. But the key is you got to get Brent above $80, and then you get all this CapEx R&D type expansion within the energy sector, which is good for European sawmills. As far as now, I'm not talking about so much the residential aspect, but more the commercial aspect of supplying wood to the energy sector in the Middle East.
All right, let's wrap it up. Great show as always. We appreciate the information, Greg. I think the big takeaway is it's holiday season, and things are going to get murky at best. Today, the equity markets and the financial markets showed just how confused everyone is. You got what was perceived to be a good CPI number. We pulled all the way back. In the lumberland, if we see demand continue to deteriorate, supply has to do something. And we do know that this is at the time of the year where supply is constrained. So I think right now it's hold your cards tight to the chest and keep looking for good information.
Yeah, and the only thing I'll add, Mike, is everybody will shift gears now to tomorrow. FOMC, they'll announce somewhere around 2:10 Eastern time. Jay Powell will have his press conference somewhere around 2:40, 2:45, and the markets will, the markets will be fixated on what Jay Powell has to say. And then looking forward into next week, we'll have housing starts on Tuesday the 20th, existing home sales on the 21st. But I think once you get into, really the 21st, I think that this thing is, people are going to sail off into the sunset for probably the remainder of the year. So if you're going to get any bigger round of buying, it's realistically this week into the first half of next week.
I just want to highlight Sigtoma points out, and he's expert on Euro lumber.
Yeah.
We are the dumping ground for Euro lumber. They're not going to shut the mills down completely. They need somewhere to go with it. So, the reality is the Europeans are coming. And the strong dollar helps them for sure.
Yeah, good stuff. No, as always, I appreciate it. If anybody has any questions or comments or wants any information, by all means, please reach out. And thanks a lot.
All right, sounds good. We'll see everybody next week, and then we'll see what happens. We'll probably have a show between Christmas and New Year's, abbreviated show, I'm guessing, and we will talk to you all next week.
Thanks, Mike. Thanks, everybody. Take care.
Bye-bye.
Bye.